point that we would make is that there's no smoking gun yet for the kind of inflationary pressures that would force the kind of, the central banks around the world to slam the brakes on. If you look at those wage gains, they were pretty narrow. We have been expecting wages to pick up, but they were pretty narrow, and it's an isolated data point. The CPI and the PPI, yeah, sure, there's inflationary pressures building a little bit. That's what we'd expect to happen over the course of the year. But so far, there's no cause for sort of, massive alarm. And I think in a sense, the big point that we would make is that the bond market only 6 months ago was really obsessing over the threat of deflation still. That is no longer possible, and that's what this, increasingly the data is not allowing it to do. So that we're in a sort of change of era, an end of an era to a certain extent. The bond market and inflation are now going to be, the bond market's going to be less friendly, so are the central bankers, and stock markets have got to adjust to that. And this period of price discovery you're seeing, where markets are behaving in a little slightly schizophrenic fashion to one inflation data point to the next, that's just the period of everyone getting used to what I would pay or what we would pay for stocks with bond yields at 3%. What happens if they go to 3.5%? How do we react? And that's kind of the period we're in now. So it's an interesting period.
Yeah, I mean, I don't think it's the central bank slamming the brakes on, but I think it's taking the foot fully off the gas pedal and hovering it over the brake pedal.
Yeah.
And, I think the Fed, 4 rate hikes this year is a done deal, and people will start to talk about risk of even a little bit more than that. So I think there is now, inflation is there, but it's not crazy high, but it's there.
So William's understating this lockstep change that we've got for both bonds and equities, is he?
I would definitely put a slightly more aggressive tone into the new higher interest rate, higher bond yield era. I think we really are now, the deflation is now completely behind us in terms of risk. And now all the debate is over how big is the inflation risk. I think that's where we are.
In your world, where you see this hysteria, but things are going to be more gradual, how then are you advising on shifts within the portfolio and adjustments of either equity bond holdings or perhaps geographical location of your bets on equities?
Well, I think the big point you've got to get to is where are the cyclical prospects, as you see them, most closely linked to price movement still. And for us, if we look around the world and developed world, that's probably Europe, where you've still got a sort of strong pickup in profitability and motion, and an economy that's increasingly sort of looking to support that story. EM Asia is another area which we like, again, strong tech component, and that tech-heavy investment period we're seeing right now, that's very helpful for that area. But in reality, although we've toned down our US exposure, a lot is going for US stocks right now, given that big, the tax bill, whatever you think about the long-term effects, and we don't think it changes the trend growth rate of the US economy, but in the cyclical terms, it's a very big cherry on a cake that probably doesn't need it that much.